Hi, and welcome back to the Business Career College video series. In this video, we're going to look at the allowance. And technically, there is a second program that's also part of the allowance, and that's the allowance for survivors. These are relatively little used benefits. There are only about 80,000 people in Canada using the allowance today. Sorry, let me make that clearer. That's in paragraph, or sorry, parenthesis there. So what the allowance is, it's designed for the spouse of a GIS recipient. And we know that a GIS recipient has to be age 65 plus and has to have low income. And what we're looking for here is a spouse who is age 60 to 64 that is not yet old enough to get GIS, so there would be no GIS here, and has low income. And we already know that's the case because we know that to do the GIS calculation, we have to look at the spousal income anyways. So we're looking at the spouse of the GIS recipient who's age 60 to 64 and has low income. Of course, once this person gets to 65, that's when any allowance would end, and that's when OAS and presumably GIS would start. So the sort of classic example of where this would be applicable would be grandma and grandpa out on the farm. Let's say that grandpa is 65 and grandma is 62. Grandpa's old enough now to start getting his GIS, and let's say he's got low CPP and low other income, no real retirement savings. And grandma is not working anywhere off the farm. She's never had a regular paycheck and therefore never contributed to Canada Pension Plan. And now grandpa starts getting his GIS, his OAS, a little bit of CPP. Grandma has no income, not much for grandpa here, so grandma would then be eligible until she gets to age 65 for the allowance. Now, the allowance is a little bit complicated. It's really sort of an ability to fast forward to get yourself some early eligibility for GIS and OAS, and the amount of benefit is about the same as the combined total of GIS and OAS for a married person, which is about $1,050 a month maximum. This amount is tax-free, and it is indexed quarterly to inflation. Now, it's subject to a clawback, and it's clawed back very quickly. So you won't have any allowance at all if you have income over about $31,000. So your income here has to be less than about $31,000. And if it's in that range, then you're going to have some allowance. It's a very complex clawback for this calculation. It's a 133% clawback on the first chunk of income, and then after that, it's a 50% clawback. So it's more complex than you'll see on an exam. You just have to know that it is clawed back and that it stops at about this level of income. But to do the actual allowance clawback calculation is outside the scope of what you'll normally have to do. Now, there is a second circumstance in which an allowance can be paid, and this is if you're the spouse of a deceased person and you would have qualified if that person were still alive. So that's where we get the survivor's benefit. If you have a deceased spouse, but you would have qualified had that person still been alive. And it's almost identical to the allowance. The only real difference here is just in the dollar amounts in the income threshold. So here you're looking at a maximum of about $1,200 a month. And here you can get income only up to about $22,000. Does actually about $22,500 of annual income, and then you would lose any allowance for survivors. Again, that amount is tax-free and it's indexed. It's not something that you're going to see a lot. I would suggest where you see this on an exam, it's more often going to be a wrong answer to a multiple choice question. But you do have this small number of people, like I said, about 80,000 people today in Canada collecting this benefit. I hope that helps. It's a fairly straightforward benefit, just a little bit of a potential red herring for some exam questions. Enjoy your ongoing studies, and thank you very much.